So I guess it was fun while it lasted. A lot of people got the benefit of several COVID-19 forbearance plans and a lot of different things that help homeowners while they were having problems due to COVID. Now, we haven't heard that word in a while, but it's still affecting a lot of people. In fact, the COVID-19 forbearances that a lot of people are still in September of 2023 are all going to expire very, very soon. When you ask, when are they expiring and what does that mean? November 30th of this year of 2023 is the end of all of the COVID-19 forbearance extensions that you have. Basically what that means is if you're in a forbearance plan right now, unless you have a very specialized type of loan, but the majority of loans aren't these specialized loans, your forbearance will end on November 30th of this year, and you will have to start dealing with the bank and figuring out how you're going to pay back all the years and months that you have not been able to pay up to that point. I'm going to talk about your options and what you can do in about 5 seconds. A lot of people have already received a letter that their forbearances are coming to an end very soon. If you haven't received it and you're in a forbearance, you will be getting one probably after October 1st. You're going to panic. You're going to say to yourself, what am I going to do? The bank is going to give you several options, and I'm going to go talk about some of them that you might have right now, the pros and the cons, and what you can expect if you were to go down the different paths. The number one, the gold standard, the thing that everybody wants, and I think the thing that you probably want, is the partial claim. They have different terms for this, but basically what the partial claim is taking everything that you owe, all the months and years, some people have been in this forbearance for a few years, putting it at the back end of the mortgage, and then basically letting you keep paying your mortgage as if nothing happened. This way they don't touch your interest rate, they don't touch the term, and your payment will not change unless obviously your property taxes and your insurance have gone up, or actually I will say this, have gone down, which they probably have not. But in any event, if your property insurance or the tax have gone up, your payment will still go up. But the partial claim, if you're offered that, that is probably the very best you're going to get. So if you're unable to make that payment, then you start moving into the next thing that a lot of people want, which is the loan modification. Now, loan modifications are good because basically what they do is they bring you current. And in many regards, this is the only option that you have. However, there is a but, and I have the but here because there is a huge but. Right now, interest rates are at 7%, sometimes even higher than that. When you get a loan modification, they will look to the current interest rate as to how they modify the loan. This is a problem for many, many people because it is unlikely that you have an interest rate that is higher than 7%. Most likely you're in the 3.5 to 4% interest rate. So what will happen is they'll take your loan, and I'm just going to do a very simple math here. Let's say you had a $300,000 30-year mortgage at 3.5%. Your principal and interest payment is $1,300 and change. That amount basically is what you are paying to the bank, the principal and the interest payment during the time that you were paying at 3.5%. Now let's say a lot of bad things happen. A lot of bad things happened to people during COVID. They lost their job, they fell behind, and things happen. Now you're looking at them and saying, I want a loan modification. Loan modifications sound great because if they don't give you a partial claim, this is basically the only thing they're going to give you. Here's the problem. Loan modification, same numbers, $300,000 loan at 7% interest, which is what you're getting now. The payment is closer to $2,000. Your payment's almost $700 more than it would have been if you had just kept your old mortgage. That is a problem. Many people say, well, if I couldn't afford the last payment, how am I going to afford something that's $700 more? That's the conundrum we're in. Loan modifications help people, but they don't necessarily solve the problem of not being able to pay the mortgage. In the past, loan modifications were the way that people lowered their payments because there was something called HAMP, and they would lower your interest to 2%. That does not exist anymore. There is no HAMP. there is basically loan modifications based on the current interest rate. So if you get yourself into loan modification, most likely your payment's going to go up. However, if you're worried about foreclosure, the loan modification will stop the foreclosure and will basically put you back on track with your mortgage. Now, let's say your interest rate is lower and you've only been in forbearance a year, so you don't owe that much. And you say to yourself, well, I don't want to lose my 3% interest rate. There's a lot of people in this situation. I don't want to lose that old interest rate. I want to keep the old interest rate. I don't want to have my payment to go up. So what can I do? There's really only one thing you can do in that situation other than paying back everything you owe. If you have that money in your 401k or something, maybe this is the time to take it out and use it to come current with your mortgage. But if you don't have that option, you have your super option, which is your most powerful weapon in these situations, which is called a cure and maintain in a Chapter 13 bankruptcy plan. This is your most powerful weapon when you don't have all the money to come current and you don't have any other options, or in the situation that I just mentioned that you don't want to lose your 3% interest and give up that to get a 7% interest rate. Now, what does that mean? That means, yes, you do have to file a bankruptcy. It's not the end of the world. A lot of people do it and most people recover very quickly. However, it gives you the option to take everything that you owe to the bank and spread it out over 5 years. So by force, the bank, for the most part, has to accept this and will basically allow you to come current over 5 years, 36 months or 5 years, sometimes shorter in very specific situations. But for the most part, expect 36 months or 60 months, 3 years or 5 years to come current with your mortgage. How does it work? You're going to have to talk to a bankruptcy lawyer in your area. This is not something that I recommend you try to do on your own. Chapter 13 is a complicated process. It is possible to do it on your own, but you're most likely going to need a lawyer. But in any event, talk to a local bankruptcy attorney in your area, ask them about cure and maintain, and you'll see that they might be able to come up with a number that you can live with and that you can save your home. That's the goal here, to save your home. So with that said, good luck. It's Mortgage Mondays. I'm here to help. So if you have any questions, type them out there on the questions there, the comment section. I'll try to answer your questions if I can, and I'm here to help.